Hi, this is Jitan from TradersTV. By the end of this video, you're going to learn how you could potentially profit from the current volatility that Brexit is offering up in the markets daily. I strongly recommend you stay right to the end because this is something you do not want to miss. You may have seen in the last episode that we talked a lot about compounding, one of the key ingredients of Warren Buffett's success. We also looked at what kind of returns are realistic from the foreign exchange market. I urge you to look at the playlist and watch the video if you haven't already done so. But for now, on to today's video. So how could you profit from the volatility Brexit is providing us daily? Well, the first thing is this, and before we even look at a chart, we need to consider 4 elements for us to be able to do so. First thing is you've got to have a plan. What is your outcome? Are you trading short term, 4-hour charts, 1-hour charts, or are you looking for more of a swing trade where you're looking to hold those trades for maybe 2 days, 3 days, maybe a few weeks or a few months? Having a plan is very important because it's going to dictate what kind of trade you look for. It's going to dictate where your stop loss is going to be, how you risk manage on the trade, where you're looking to get out. It's very important we have a plan rather than be reactionary in the markets. And too often I see this. I see people seeing these news flows, these kind of volatile events, these big moves, and they're reacting to what the market is doing rather than allowing the market to come to them and their own analysis and their own preparation. So having a plan on how you're going to trade is going to be so important. Okay. Second thing is this: you've got to know what your strategy is. It's not enough just to have a plan. You have to have clearly defined rules for your entry and your exit. And what I mean by clearly defined rules, your parameters, the inputs you're using. Are you using price action? Are you using horizontal support and resistance levels, Fibonacci levels, moving averages? Are you using indicators within your strategy? It all has to be clearly defined, the tools that you're using and how you're piecing them together. In previous videos, we've looked at different tools you could be using in the markets, and in other forthcoming videos we're going to look at even more extra tools. Some of you already have a strategy, but it needs to be clearly defined. Okay, the parameters that require you to actually place a trade need to be written down within your trading plan. And then basically you're measuring your trades against what you should be doing, or what your plan of trading is, or what your strategy is. It's really important we don't just turn up to the market saying, hey, I want to be buying this or selling this. We've got to have some kind of plan on how we're going to do that as well. And the strategy is very important. The key here is also to have clear exit rules as well. Too often I find it's so easy for people just to get into a trade. A lot of people are happy just to buy or sell and get into a trade. But actually when it comes to getting out of a trade, that's where they have a lot more difficulty. Knowing when to cut your losses, knowing when to let your winners ride. Okay, you have to have some kind of clearly defined exit criteria. I also see a lot of people, they're saying, okay, I'm going to come out of this trade, and suddenly it starts keeps on going higher, and they start moving their target prices, and then suddenly it comes down, and they should have taken their profits, and now they're in the negative, and they're left all frustrated. And again, it's not a way to trade. Okay, when you're trading a larger sum of capital, remember the people you're trading against. More resources, more capital. Okay, you have to play at their level in order for you to be successful. It's really important you have a plan and you know what your strategy is. If someone came up to you and said, what's your strategy? What do you trade? You should know it like the back of your hand. Really important. The third thing is this: you need to watch your risk. We've just talked about risk management in previous videos. Risk management, very important. We're not just talking about trade risk, we're also talking about reward to risk, market risk, portfolio risk. You don't want to have too many positions open on the same market just in case something happened and it turned around. Okay, so understanding and watching your risk is going to be a key criteria to your success. Too often people just think about the rewards, and they're not thinking enough about, is my stop loss in the right place if this trade goes against me? Am I sticking to my reward to risk targets in order for me to benefit from the win-loss ratio? Okay, where actually I can lose more times than I win, but still make a return if I'm trading at a higher reward to risk, like 3 to 1. Okay, 3 to 1 reward to risk really for me is like the magic number. The reason for that is every time I lose on a trade, I lose 1%. Every time I win on a trade, I win 3% or make 3%. So I like that ratio. Okay, losing 1% when I'm wrong, making 3% when I'm right. The beauty about that is if I got the trade wrong 3 times out of 10, if I got the trade wrong 7 times out of 10 and only won 3 times, then on the 7 trades, I've lost 7%, but on the 3 trades that I've won, I've made actually 9%, and I've actually made a profit overall, even though I've lost 7 times and I've only won 3 times. So reward to risk is going to be very important. But also the technical levels about knowing when to come in and out of a trade are going to be quite important as well. Exit criteria, having target levels in mind. You may not just have one target level in mind, you may have a few target levels in mind. So you can really try to capitalize on a bigger move. But it's important you do your analysis and don't just leave it up to hope. Don't just hope the market's going to move in your favor for a long time. Have some kind of target criteria in mind, because it's important you have to bank some of your profits as the trade moves in your favor. The fourth thing is this: review. And this, for me, is by far one of the most important parts. Because as with any trading business, if you're not reviewing what is working for you and what is not working for you, how do you know what to improve on? How do you know what you need to work on? It's really important we understand what your strengths and weaknesses are as a trader, because we're all bringing something different to the table. Having a weekend review process where you look at the commonalities between your winning trades, look at the commonalities between your losing trade, try to identify those commonalities. It will give you a great insight into capitalizing on your strengths and give you what you need to work on your weaknesses for you to become a better, more well-rounded trader. So the review process is very important because it gives us insight in terms of what we're doing right, what we're doing wrong. We want to capitalize on the things we're doing right, and we need to work on the things that aren't working for us to make sure they don't eat into our profits. So the 4 things are very important for you to be able to potentially profit from the current volatility in the markets that Brexit is providing. You have to have a plan. What markets are you trading? What time frames are you trading? You have to know your strategy. Clearly define rules for entry and exit criteria. You have to watch your risk, making sure you're not risking too much that in one trade you blow yourself out of the water. Giving yourself enough of an opportunity to allow probabilities to work in your favor. And of course, the review process as well. Trying to find out what is working for you, what isn't working for you, so you can keep on adapting and performing well in different market conditions. So those are the 4 criteria. So let's have a look at the chart and I'll show you how I'm looking to profit from the volatility that Brexit is currently providing. So here we have a chart of British pound against the Aussie dollar. The reason the British pound is even on my radar is because of the current volatility that Brexit is providing to the market. And pound has been on my radar because of my weekend analysis. I do see some further upside in the British pound. And this is where the review process is important. I look back at my historical trades, on a week by week basis, and from that I can learn a great insight in terms of what's happening in the market. I can look at the market on the weekend objectively. Markets aren't open, I'm not impulsed to take a trade. I can look and review at the markets and I can build a plan of what I want to be trading throughout the rest of the week. Just so happens that looking at the British pound against the Aussie dollar, I can see that we're trading within this longer term ascending triangle formation. And because we've actually bounced off this support area at the bottom, there's a very high probability that the market is moving its way to this area here. So I know that I want to be trading the British pound, and I can see from this chart pattern here that actually it could be a good plan to be trading this to the long side. However, what happens if I'm wrong? Because I don't get every single trade right. I don't need to get every single trade right to make a return. In this particular example, I'm looking for a reason to be a buyer on the British pound against the Aussie dollar. Okay, from my weekend analysis, from the plan that I set out at the beginning of the week. Just so happens that on one of the strategies that we have on the Smart Charts platform, there's actually a long setup on British pound against the Aussie dollar. You can see the arrow here. You can see here on pound dollars telling me to be a buyer. So fantastic. I've got my plan meeting up with this strategy here. This is actually called the interbank radar strategy. And it's actually telling me that there's a high possibility of the market going higher. However, I need to do my own analysis to make sure this trade fits into my plan and what I want to look to trade. So looking at this market here, the key thing for me is I have a plan. Okay, these are the markets that I want to buy or sell. I've got my strategy telling me to buy a market that is on my watch list. Okay, fantastic, we're putting the pieces of the puzzle together. However, I've got to watch my risk. I've got to make sure that I'm actually not over risking on this trade just in case I'm wrong. Yeah, we have to allow for probabilities to work in our favor, so we've always got to watch our risk management. But the key as well is reward to risk. Is there enough reward to risk in this trade for it to be worthwhile? And actually where we are right now, where I'll be looking to be a buyer here, I'm actually long on this already, as you can see. I have a stop loss here, so that's my risk on the trade. Okay, so in effect, let's say that was 200 pips risk. I'm risking 1% off my trading account, 200 pips, and I can see there's a very high possibility of the market moving towards this resistance level at the top, because remember, we're trading within this long-term ascending triangle formation. So based on that analysis, there's a very high probability that market could get up to this level here. Yeah, so that in effect, if it did get to that point there, would give me a 3% return if it did get to this point. Okay, however, I could be wrong on this trade. So if I am wrong on this trade, I have a stop loss in place, and the worst case scenario is that I've lost 1%. The worst case scenario, I've lost 1%. If it goes off and hits my target, yeah, I've made 3%. Trading on that reward to risk, I know is great, okay, because we're then on the right side of the win-loss curve. In this instance, if I'm trading at a 3-to-1 reward to risk, I know that if I lose 7 trades, okay, and win only 3 trades, I'm still making a return, and that's very important. So this is where, on this particular trade, I had my plan from the weekend. These are the markets that I want to be trading, and these are the time frames that I'll be looking to trade. These are how long I'm looking to hold the trade for. Okay, but these are the particular markets that I want to be trading. The strategy then came next. Okay, it just so happens that the interbank radar gave me a way to get into the market. Okay, however, I had to watch my risk to make sure I'm not over risking on this trade, yeah, and that the reward to risk is enough for it to be worthwhile. Now, after this trade either stops me out at a loss or hits my target at a profit, I would also review the trade. Okay, what was good about the trade? Okay, regardless of it won or lost. I could have a losing trade, but it could still be a good trade because I followed my plan, I followed my system, and there was plenty of reward to risk available. Because I know if I follow those 3 steps, then over time I'm able to make a consistent return. Okay, now of course you have to allow for your learning process as well. That's going to be very important. We've all got our own learning processes to overcome. Some people it's going to take longer than other people, but you have to allow for that process. When you first start trading, try to think less about the returns, about the profits, and try to think more about instilling the right habits, having the right system in place, having the right strategies in place. Because trading is a skill set like any other, and to build a good skill set, you need to become a good habit. So focus on having the right processes in place first of all. But here's an example where I followed my plan, I followed my strategy, I watched the risk, and I'll also add this to my journal to review once the trade has completed, either at a loss, ideally in a profit. Either way, I can look back at this trade, regardless of it lost or won, knowing full well that it was a good trade because I followed each stage that I needed to follow on every single trade that I take. And I strongly urge you to do the same thing. Have the same processes in place which you follow step by step on each and every single trade that you take. Now you know how you could potentially profit from the current volatility that Brexit is providing the markets daily. If you have any more questions or want further insights, then I strongly recommend you visit the link below and attend one of our free Forex workshops. I'll see you next time.